Welcome, everybody, to Secret Sauce, the show where we unpack business tips, life hacks, and advice from industry leaders. I'm Karly.iacono. Today, I am so happy to be joined by Jason Kessler, the CIO of ARCTRUST. Jason, welcome. It's great to see you. Thanks for joining us.
Thanks, Carly. Thanks for having me. Great to see you this morning, and Happy New Year.
Thank you. Thank you. Same to you. Hope your year's off to a great start. So why
Absolutely.
don't we kick off today's episode with a little bit of background on ARCTRUST and your role there?
Sure. So ARCTRUST is a 35-year-old company. We focus on net lease investment and development. And today we're most active in our Paver program, which are protected appreciation vehicles in real estate. We do that through preferred equity investing and development. And we specialize in retail net leases, multifamily, self-storage, and some industrial. Over the course of our 35 years of existence, we've acquired or developed over $5 billion of real estate and 500 transactions. So we have a wealth of knowledge and experience and a large background in multi-asset investment.
There's so much we can dive into in that because you really have a great understanding of various asset classes, the development, the acquisition. There's a lot of pieces of the market that you guys touch. So I'm excited. Let's start with where you think we are in the market, just your general thoughts on the market, and then we'll dovetail into how you're changing your investment thesis based on current market conditions.
Sure, thank you. So right now, obviously our market is a little turbulent. We have interest rates moving, and the pace at which sellers are adjusting cap rates isn't matching the pace at which debt is moving in the marketplace. So we're seeing a lot of price discovery on behalf of sellers, and I think buyers just aren't at a place yet where they have confidence in what the debt frame is going to look like 2, 3, 4 years down. So where we're investing today is mostly through our Paver and development program. We're seeing a lot of requests for capital given the capital stacks are evolving every day. Leverage is down, lenders are very conservative, and interest rates are up. So in each deal we're looking at right now, there's a slice of capital needed. Sometimes that could come in the form of a pure development deal where we'll form a joint venture. And other times that will be a limited partnership where we'll be the LP and the sponsor will be the GP or the general partner. So through that investment cycle, we're able to focus, as you mentioned, on different asset classes, differentiate ourselves, and spread our risk around a multitude of investments.
I really think taking a piece of that financing equation over the next year is where the most opportunity will be. That's where we're seeing the greatest need as well. So in your Paver program, what does that percentage look like? How big of a part of the deal are you? Are you working with traditional lenders alongside? Like, what's the structure look like?
Sure, great question. So the basic program, we encourage all of our sponsors to use community-based lenders. We're looking for lenders that'll be aggressive in their underwriting, understand the product we're delivering, but also be aware of the market. So we're looking for flexibility on prepayment. Like you mentioned, a 1 to 2 year horizon. We think a lot of these deals will be ready for a refinance in a better economic position. And we're also looking to maximize current proceeds. We like our sponsors being able and willing to sign recourse. That means that they're really believers in their project and have a balance sheet that the lenders will accept in understanding the risk of that investment.
So are you staying in these deals when you're supporting, it sounds like you're supporting the developers really with this piece. Are you staying in the deals long term? Is this a short term financing vehicle? What's your horizon look like?
Very interesting. Each deal takes on a life of its own. Certainly, we would like to be involved in the ownership of these transactions long term and ultimately grow our REITs with these development deals that then become long-term assets under management. However, there are certain transactions where a developer needs a limited slice of capital. That could take on the form of a mezzanine loan. It could be a preferred equity with participation. And on those transactions, we do allow our developer to monetize the program, and we will exit the deal in anywhere between 2 and 3 years. We really don't focus on anything under 18 months And we understand sometimes that, 2 or 3 years is a more likely horizon. And we use each asset class we're investing in to base that. For example, in a retail development deal where you're delivering a pad to a tenant, that could be stabilized in 6 to 9 months. On the other hand, a multifamily deal of 300 apartment units, or a self-storage deal could take 3 or 4 years to develop and stabilize. So we'll manage the time frame along with the project's needs.
So you're really involved all the way through stabilization, and then in some cases even longer as it gets folded into the REIT, correct?
100% correct.
Nice, nice. So let's move away from the development equity piece and talk about the overall strategy for the REIT. Where are you seeing opportunity in the market? Are you looking across all asset classes, or are you really focused on the core, which has been retail net lease moving forward?
Sure. So on the acquisition side, it's mostly focused on retail net lease. Where we're seeing some opportunity is on short-term leases. So our history, we are buyers of intrinsic value real estate. So fundamentally, we look for great corner properties at below market rents. And if that means in today's market that we need a short-term lease, we're confident enough in the real estate and our ability to execute on redevelopment that those are the opportunities that are most attractive to us today.
Are you still seeing a lot of tenants be open to the idea of blend and extend? That was such a big buzzword for the last, 10 years, right? Take the short-term lease. For those of you listening who aren't familiar, short-term lease, you negotiate with the tenant after closing, and then you blend it out over a longer term, sometimes giving up a rent increase. There's different levers to pull, but that was the goal, right? Buy the short-term leases and then extend them. Are you finding that tenants are still open to early extensions, or has that become a little more challenging?
It's still a prolific business of ours. We're very active in the blend and extend space. We've done hundreds of them for pharmacies. We've done them for gas convenience stores. We've actually done them recently on industrial deals, and also with almost every asset class. We've done quick serve restaurants. So we are big believers in the blend and extend space, and very active in that marketplace. There is some thought, and there are a lot of owners today who, using inflation as a base, believe that rents are going to have gone and will continue to go up significantly. So some tenants require pretty significant rent reductions to blend and extend, and many owners aren't willing to give those. Another area that we've seen in blend and extends is actually buying some deals that have already experienced a blend and extend. Because oftentimes the more prolific tenants, when they do require that deep rent discount, they now have a below market rent, and that becomes an attractive opportunity for us. So we look at it on both sides of the spectrum. We're active in doing the blend and extend, and then also we're interested in purchasing the deals after they've already been extended, in some cases where they make sense to us on an intrinsic land value basis.
And I think that really comes back to where you can find below market rents, because
Absolutely.
that, right, is intrinsic value, and in most deals gives you a lot of flexibility moving forward. So that makes sense.
Totally.
What about rent increases? Are you being flexible with tenants? Are you demanding higher rent increases because of inflation? Have you really changed or seen any material changes in the lease structures?
We're trying to. Obviously, in the pharmacy space, those rent structures are pretty well defined. There are typically no increases in those rents. We have seen some newer deals where there are 5% increases, which isn't great, but it's better than a flat lease. And we are sensitive to increases also in the option period. So we have seen some leases where during the options we've been able to get greater increases than during the base term. And on most of our development work, we do have increases, especially in local shop space. We're looking at 3+% annually in increases. And then also, that's one of the great ways we differentiate in the apartments and self-storage deals. Those transactions aren't under long-term lease. You have the opportunity to reset that lease either at every turnover, at every year, and they're pretty sticky businesses. If you have your matters in a self-storage locker, you're very unlikely to move. So you can see 3.5–4% annual rent increases in that asset class almost on a recurring basis.
Very different, right? Each asset class really is so different in how it's structured and where the risks are, which makes it interesting to kind of create a blended portfolio to diversify the risk.
Absolutely.
Are there any tenants that you are extremely bullish on or excited about for this upcoming cycle? Anyone that you're targeting, I guess?
Yeah, like I said, we're mostly focused on the underlying real estate, so it's very rare that we chase a specific tenant. There are a couple that we view, have some longer term stability. We've purchased a couple Harbor Freights. We do a lot of development work for Wawa, and we're focused on a lot of QSRs that have drive-through components to them. Not so much specific brands, but more so the location and the underlying rent.
Makes sense. Anything else you'd like to share on the market or your investment thesis before we move on?
I think right now diversification is key. I think you really want to be spread to see different asset classes. And like you mentioned, have a portfolio that you're seeing. Some might be flat leases, some might be long-term net leases, and some asset classes that have opportunities for rent increases on an annual basis and a much more opportunistic period, especially with where the debt market is.
Agreed. Thank you for sharing. So moving on to the second part of our show, the secret sauce. What tips, advice, or ideas do you have for our listeners that we have not covered yet?
Sure. So as I mentioned, we do a lot of development work, and in the development space, it's a very detailed business. Development in the Mid-Atlantic states, be it New Jersey, Pennsylvania, Maryland, this can be a 4 or 5 year undertaking. And so you've got to have a lot of staying power. You've got to be meticulous on your details. A couple of things we like to do is kind of a measure 3 times, cut once. We're always looking at our plans. We're always looking at our budgets and our schedules, and they're going to change. What starts off will go left, will go right. And hopefully at the end of the day, you get back to center. But you've really got to be conservative in your underwriting. Make sure you have enough spread in that deal and enough time to get the task allotted completed.
I find that developers by nature are overly optimistic in a lot of cases, and which is great. They're a lot of fun to work with, but sometimes there is not enough spread. There's not enough wiggle room because they assume everything, of course, will go exactly as planned or better. So that's good advice coming into this market cycle, to be a little more careful and leave yourself some more room on all these different areas, time frame, deal spread, etc. So
exactly. In development by itself, if you weren't overly optimistic, you would never start a project.
Right.
Developers need to be overly optimistic to get things started, and just need to be cognizant of where we are today. For example, I was on a call this morning with a developer in Georgia, and there is a shortage for concrete right now in Georgia. And with the weather being so wet, if you miss your pour, you go to the end of the line, and you could be sitting 3 to 4 weeks with your building just waiting for a concrete pour. Something we would have never imagined 2 or 3 years ago, but this is the world we live in today.
Right. So many stories like that too, in different areas with different materials and delays. It's just the one thing that you think would not be an issue is usually the one that is. So
absolutely.
Thanks for bringing that up. Anything personal or any other tips that you'd like to share before we wrap up?
Yeah, I think a couple good ideas right now is obviously the good old 80-20 rule. 80% of your success or your deals or your closed transactions will likely come from 20% of your effort. And the inverse of that is also true. That balance of the other 80% could only yield to the 20% results. So I think you've got to really focus on what we can get done and what's most achievable. And I think that'll lead to a lot of success.
Having a clear vision and focus is always good advice. So thank you for reminding us that 80-20 rule. I appreciate that. It's something I keep in mind as well.
Absolutely. We're all deal junkies, and we love to chase deals. We like to think every one of them we can get done.
Of course, right? Going back to that eternal optimism. You got to have a little piece of that, but some realism too. So yeah, thank you for breaking that down.
Absolutely.
Jason, this was great. I'm so glad you were able to come and join us and share your thoughts on the market and kind of the vision and direction of ARCTRUST. We really appreciate your time, and so happy you could be a guest with us today.
Thanks for allowing me to join today.
My pleasure. To everyone listening, that was Secret Sauce. We appreciate you tuning in, and we will see you again very soon. Take care.